Hello, and thank you for joining us this morning. My name is Chris Coleman, and on behalf of Fiduciary Investment Advisors, it is my pleasure to kick off today's webinar. Fiduciary Investment Advisors, or FIA, is an institutional retirement plan and investment consultant with offices in Windsor, Connecticut, Boston, Massachusetts, and Kennebunk, Maine. We are an independent firm that offers customized advice to a broad array of institutional clients, including retirement plan sponsors and endowments and foundations. In total, we advise over approximately $47 billion in fiduciary assets. FIA was recently ranked as one of the top 50 institutional consulting firms by Pensions and Investments, as measured by assets under advisement. This morning's webinar, FIA's second quarter capital markets review, is scheduled to last approximately 15 minutes, followed by the opportunity to pose questions to our speaker. Questions can be submitted via the question box on your control panel at any time during our webinar. It's now my pleasure to introduce FIA's Chief Investment Officer, Chris Kashmar, who will lead us through this morning's discussion. Chris?
Thanks, Chris, and good morning, everyone. We appreciate you spending a couple of minutes of your day with us. I think has become our custom. We're going to hit the highlights today, kind of talk as we have in the past more broadly about some of the bigger picture themes rather that are resonating with investors. We'll spend a little bit of time graphically on some of the representations of those themes, touch base on capital market outcomes and performance mid-year, and maybe conclude a little bit with some ideas around, super high-level ideas around portfolio construction. I think as you all well know, as we get into reporting season with many of you, you'll have much more granular and detailed conversations with your consultants. So with that, if you see the very first page here in terms of macro themes, certainly a lot of the talk is centered recently around the magnitude of central bank activity and how prominently they figured in investor psyches and capital market outcomes for that matter, and some of the challenges that they have against these backdrops dually of a pretty modest global economic growth environment and projections for more of the same. And then certainly as evidenced by Brexit and maybe to a lesser extent here in the U.S. with the presidential election activity, an increasingly fractious political environment. So if you remember, not too long ago, the Fed had instituted the first in what was anticipated to be a series of interest rate hikes toward the end of last year. If you remember, the year got off on a pretty unequal or an uneven footing rather, with some meaningful consolidations in risk asset prices and equity prices, and the Fed, in conjunction with some of the concerns overseas, stepped away from the more aggressive path that they had first adopted, and now as we sit here today, certainly has this challenge of being particularly aware of what's going on overseas. Mixed economic data here in the U.S. We highlight here the June labor report, the employment report, which was somewhat stronger. The market's handicapping maybe one more rate hike in the calendar year, but they've stepped away from that more aggressive path that they earlier thought might be appropriate. And then, of course, countered by what continues to happen overseas with their counterparts in Europe and Japan, for example, and to a lesser extent China, where stimulation is still all the rage and needs to be a rage against even more tenuous conditions in those locales. The interesting thing to us, I suppose, is that monetary stimulus to some extent certainly has incented investors. You've seen what's happened with interest rates, and you've seen that equity prices have been pretty hardy, surprisingly enough, all things considered. But we do have this suspicion that we're kind of testing the limits of the effectiveness of monetary stimulus, and the next natural leg of support for the markets would come in the form of fiscal stimulus and some type of structural reform. But the landscape for that overseas is a little bit challenged right now, so we wouldn't expect too much activity on that front in the immediate future. Just playing out a little bit on the idea more specifically with respect to global growth, you see there that the environment globally is pretty soft. We note here the World Bank projection for growth in June. They came in at a 2.4% expectation, down from January. The IMF, the International Monetary Fund, kind of in cohorts, has reduced their expectations for global growth, most recently in April. They come next week with their kind of mid-year update. We have every expectation that they'll probably temper those expectations once again. They're running somewhere on the order a little north of 3% in terms of their expectations. If you look with a little more granularity into the different major segments of the global economy, the barometers for the U.S. market have been kind of interesting. I guess on balance, slight balance, maybe trending to the positive side. But we note here, you saw the quarter got off to a decent start with some of the data points that investors like to center around, whether it's industrial production, LEI, or leading indicators, and some of the ISM survey activity around non-manufacturing activity. Actually, were pretty decent in April. It contracted in May to some extent. We've seen non-manufacturing activity pick up again in June, but really a mixed bag here. And so it's certainly not a kind of an outright and strong gain or advance in macroeconomic activity, but somewhat of a mixed one. Overseas, it is obviously way too early to have any definitive sense around what will transpire with the Brexit vote. I think certainly the consensus in the market is that it will have a dampening effect. You probably read and saw this morning that the UK authorities kept rates where they were at 50 basis points, but kind of hinted later in the summer that they're likely to stimulate additionally. So that has kind of set the markets off on a strong foot this morning anyways. And then elsewhere around the world, China continues, with these stated objectives of growing somewhere in the mid 6% type range, 6.5, 6, 7 thereabouts. Their challenge continues to be the one that we've talked about in this setting for quite some time now, and that's this notion that there is these lingering frictions that exist in this transition, what the authorities want to ultimately be a fully mature and consumer-centric economy. But there is some nascent evidence that they are making headway on the transitions and on that front. And in Japan earlier in the week, if you caught it or not, but Abe's kind of electoral reaffirmation comes with him continuing the program, the Abenomics program that we've talked about, and there's more stimulus on the way likely in Japan. So an uneven picture, but one with undercurrents anyways of maybe some positive things in the second half. You bring this all together, some maybe the artificiality to some extent that the central bank activity has engendered in the capital markets, modest macroeconomic growth and expectations. That sets the table, we suspect, for what in the second half of the year will continue to be a somewhat challenging environment for investing. We've had these periodic bouts of volatility, as you all well know. We have every expectation that volatility will continue, and it comes alongside the notion that risk assets are at or near, in many cases, full approximations of fair value. So we don't have a lot in the way of leeway in terms of where we may go. And we've talked to you about this, I think, when we saw many of you in your previous review meetings, and we'll talk about it again this quarter, of course. The expectations for capital market returns probably are best truncated given all these conditions and challenges, and I think you all well know that. And have thought about that, and as we kind of work through your portfolios and situations, we'll talk more about it as well, of course. We thought this was an interesting page, central bank activism. You've read about it, I suspect, to a great degree, and it's a pretty outright picture visually of what is a brazen experiment by central banks around the world to try to keep growth moving along at whatever positive pace is possible and try to reinflate economies. And it has gone to the extreme, obviously, where you now see that there are large swaths of the world where rates are very low or outright negative. And the far right-hand side, or the right-hand side of that exhibit, you see some of that depiction there. You know, a full 3/4 of global government bond yields are below 1%. And that is completely and absolutely unprecedented. And it does leave us perhaps in a tenuous position, and one that is likely going to kind of filter through to the psyches of investors for quite some time. We don't have a blueprint to move in the other direction, as you all well know. We've talked about this now for quite some time. It's noteworthy. It's a challenge. And we're just going to see how this all plays out. I know there's been some talk along the way. You've probably heard and read about could negative rates come here in the U.S. And I don't know if you saw Vice Chairman Fisher's comments earlier in the week, but to paraphrase him, there's no plans to move into negative territory, and we will try to avoid ever getting into that position. So that's at least one Fed governor's position on that front, but we'll see what transpires there. You know, this creates real challenges. You know, certainly from an investing standpoint, you know, rates are where they have never been before. So we're going to have to monitor that and keep tabs on that on a go-forward basis, and what implications it has for portfolios and investing longer term. And then just another simple depiction visually of economic growth. We talked a little bit earlier about the World Bank's reductions in their expectations, the IMF's as well. This is the IMF survey just on a calendar year basis, and you can see again, you know, scaled in terms of an absolute return growth expectation, pretty modest expectations. Again, the July numbers, the mid-year numbers come next week. We have had some early indications from the IMF on a preliminary basis around the potential effects of Brexit on Europe. If you haven't seen those numbers, growth is expected, at least on the IMF's count, to hover somewhere around 1.6% in 2016, probably down to 1.4% in 2017. Those are against original forecasts in both cases of about 1.7%. And that goes in hand, as you would expect, with pretty modest expectations for inflation in the euro area as well. You know, maybe 0.3% this year, and a little north of 1% next year. That still runs, as you well know, kind of behind that long-standing central bank target globally that's talked about, that's a 2% inflation or thereabouts for a smoothly functioning economy. So that's a little bit of backdrop on what's going on year to date at the bigger picture level. Let's get a little more detailed just in terms of investment returns and outcomes. These are mid-year numbers. We're going to focus on the first column on this exhibit, the quarterly numbers, and you do see mixed returns, but some decent returns from certain areas of the market, as you probably expect given the headlines. The U.S. markets generally perform somewhat more strongly than their international counterparts, and we'll flesh that out momentarily. If you can kind of focus your attention on those first three rows, on the quarter, you can see that small cap stocks here in the U.S. did best, up just shy of 4%, followed by their mid cap and then larger counterparts in the form of the S&P 500. But consistent returns, up and down the capitalization stack, if you will. Why the advantage for small cap? At the highest level, if you think about some of the dislocation going on in Europe, in a sense that smaller companies here in the U.S. are somewhat less tethered to that instability. You can get maybe a high level appreciation for why small cap stocks did a little bit better in the quarter. Another undercurrent that we don't depict here, but maybe is worth noting, is this kind of started to occur when we were meeting with you in last go-rounds and has now persisted. Value as a style here in the U.S. has outperformed growth, and pretty meaningfully so year to date. If you think about where yields are and rates are that we just kind of fleshed out a few minutes back, things like telecom and utilities and the like that have inherent yield advantages, and in a yield-deprived environment like we've got, have gotten a lot of investor sponsorship, and those type of names have higher weightings in the value indices and have driven that relative performance advantage. Overseas, you see that developed stocks, EFA stocks, as you probably would suspect, given the descriptions and information we just went through, were the laggards on a relative basis, down about 1.5%. EM's been a pretty interesting story, and a kind of persistently decent returns there, all things considered. Certainly when you extend the lens a little bit, it's been an area of struggle for a lot of investors, but more recently emerging markets have done fairly well. That goes in large part, as you would suspect, if you move your finger down the column there, to what's going on with the commodity complex. And we've had gains in the energy front and elsewhere, and that historically has been in a backdrop that's been constructive and productive for EM returns. So EM has actually held in fairly nicely. And then finally, on the fixed income front, you've got again, amazingly enough to us, just given where base interest rates are, that you're running off over the last year a 6% total return for high grade fixed income. Pretty amazing. And you can appreciate the uncertainty around Brexit. Some of the mixed economic data has kind of incented rates, or forced rates, or caused rates, whatever you want to use there, to continue to move lower. The 10-year today here in the U.S. is about 1.5%. We'll see how low it can go, but it has been remarkably well behaved, and certainly some of that behavior and good response has come from demand from overseas investors, as we talked about, where rates for counterpart bonds are in many cases negative. And then finally, one last note on goings on in the markets for the quarter. We don't depict it here explicitly, but other areas of the bond markets did well also in the quarter. So things like investment grade credit and high yield, as you'll see when we get out in the field with you in short order here, enjoyed pretty healthy returns as well, and in many senses accretive even to the total returns that were achieved just from, for example, Treasury bonds. So a by and large decent quarter all the way around. You don't have it in the exhibit here, but I think as everyone on the call is probably well aware, the markets have kind of turned on the heels of the end of June instability. And we're showing the S&P in the month of July up about 2.6%. Small cap stocks here in the U.S. are up 4.3%, and international stocks even are up, somewhere on the order of 2.5% to approaching 3%. So there has been this modicum of stability on the immediate heels of what was a pretty dour environment there for a couple of days with the Brexit situation. Then I think the final thing that we were going to offer up in terms of prepared comments, just quickly, these exhibits may be familiar to some of you. This we pulled out of a communication that we provided to you again on the heels of Brexit, and we had thought it was interesting to kind of go back through recent history and look at other environments where volatility had elevated, and using that spike in volatility as a proxy, for investor concern and consternation, I guess, and kind of just testing the thesis as we oftentimes talk to you folks about regarding staying the course and being disciplined with allocations, and the adaptiveness of markets, more often than not, the best course of action being to kind of sit on your hands, as frustrating and anxiety inducing as that can be sometimes. So we tested here explicitly. You can see we looked at spikes in volatility, and we used the VIX to do that. And then we looked from that point at subsequent returns for a representative balanced portfolio. You see those numbers down below. If you go to the very bottom of the page, you can see 1 month, 3 months, 6 months, and then where it's applicable a full year. And by and large, on the heels of those events, the disciplined investor has made out okay. Now, in all, we readily admit, this isn't a highly sophisticated study. We haven't controlled for the macroeconomic backdrops, and we're certainly aware of that, but we do think it's a good proxy for some of the virtues of staying the course in times of crisis. And again, these are concepts and discussions that we'll have in greater detail with you in the coming weeks. So with that, I think we're running on up against our time frame. Let's see, to the extent that there are any questions, and we can give more detail on.
Great. So this is Chris Coleman again. Chris, thank you for those great comments. And we are, to your point, running against time. We have had several questions come in, and we appreciate those from the audience. For those that we don't get to, we will reach out to you individually, though we have had a number of questions come in with a general theme regarding Brexit and the recent volatility and thoughts around what that could mean in terms of a global recession. So maybe you could close with 30 seconds commenting on that, and we appreciate everybody's time.
Sure, Chris, thanks. So I think in terms of a global recession, are we forecasting one? We're not. Have the chances elevated somewhat for that on the heels of what's happened recently? Perhaps. Where would a recession come from? You'd have to have significant deterioration here in the U.S. macroeconomically. And we talked earlier, we haven't seen those trends in the data. Data has been mixed, but there's certainly been many points of positivity there. So we don't think that you're going to have that activity here in the U.S. You'll have to have what is an outright complete dislocation in Europe, we suspect. We talked about how tepid growth is there. Now, could something happen with, the U.K. Dragging things down? I suppose, but again, the comments from the central bank there this morning are somewhat reassuring and have given the markets, some I guess positive feedback. The other thing that is out there that we haven't talked about is the situation with the Italian banks and the forthcoming referendum in October in Italy. I suppose on the extremes that could be a problematic issue, but it's tough to forecast. Certainly there's a lot of attention being levied on it, and we're hopeful that they'll be able to navigate through that situation. And then finally, the third leg of the stool, I suppose, would be an outright hard landing in China. And again, the data there does not at least suggest that. So we kind of bring that all together. Will we continue to persist with pretty modest economic growth? In all likelihood. Our expectations for capital market returns kind of somewhat cautious and modest. They are, but will we see an outright global recession? Our best sense of the data is that we will be able to navigate around that by and large.
Excellent. So we're now just a tad past 20 minutes. We want to be respectful of everyone's time. On the screen, you can see email addresses and contact information for both Chris Kashmar and myself. And at the bottom, you can see a generic marketing address. If you have any questions, if you'd like the slides, feel free to reach out to us at marketing@fiallc.com. And with that, we'd like to thank everybody for their time this morning and wish you a great rest of your week. Take care.